Module 5.2 is a major turn in our understanding of options, moving from boundary conditions and parities in Module 5.1. We now turn to the first of many cash flow adjusted approaches to valuation, specifically the binomial option valuation model. The geometric Brownian motion-based model is contrasted with the arithmetic Brownian motion model, which will be covered in Module 5.2. So the objective here is to explore the GBM model, which is a multiplicative model, and in the limit, the binomial model is discrete, and in the limit, it's going to converge to the geometric Brownian motion or a terminal log normal distribution. One of the key attributes of the GBM-based binomial model is that it is recombining. We'll explore different ways to incorporate dividends and some of the problems that causes. There is an enormous amount of material in this chapter on digital options. Digital options are either cash or nothing or asset or nothing, and are very useful in navigating the nuances of very specific exotic options. It also helps in understanding the component pieces of just the vanilla options. We'll look at both European style and American style options, and we're going to generate a whole host of plots. So the central finance concepts, first of all, it's geometric Brownian motion in the limit. It's a binomial option valuation model. Binomial, bi means two, so there's two arcs for every node. And it's a valuation model in the sense that our goal is to come up with a theoretically justifiable value of the option. We'll take a careful look at 1 and 2 period models in order to get some of the fundamentals down. We will examine the geometric Brownian motion coherence conditions. Many of the current binomial option valuation models actually deployed in practice are technically incoherent, and we'll explore some of the implications there. Dividends perform a very interesting role in option valuation, and how to handle that within this model will be explored. We'll look at multi-period models, and numerous graphs will be produced based on the R code that is provided. The geometric Brownian motion binomial framework is multiplicative. We'll look at what this means is basically if I go up an arc and then down an arc, I'll arrive at the same place as if I go down an arc and up an arc, mainly because the way the underlying instrument grows is multiplied by either U or D, representing the total return if up occurs or the total return if down occurs. It's very important that the binomial tree recombines for a host of reasons, primarily because the speed at which computations can be done is greatly sped up if the tree recombines, and it becomes virtually impossible in a non-recombining tree to do analysis with a high number of periods. We'll incorporate dividends, both discrete and continuous, and we'll address the early exercise feature of American style options. When we explore the binomial lattice in technical details, it's typically easiest to first look at the 1 period model. It's a really nice heuristic. It's like a toy car. It illustrates many intuitive ideas that are embedded in the binomial model, and it's simple. The 2 period model allows us to explore dynamic rebalancing, which will be important in how these models work. The multi-period model is what's actually deployed in practice. It's much easier. European style requires only analysis at expiration. American style requires addressing potential early exercise. And as we'll see, it involves what's known as backward recursion. The geometric Brownian motion coherence conditions, the requirement we require that it converges to the log normal distribution, It seeks to avoid arbitrage within the sterile theoretical environment. Actual option markets are much more rough and tumble, so to speak, and these theoretical assumptions have to be relaxed. However, the binomial model is deeply useful when exploring alternative models to deploy in practice. Discrete dividends. Many lattices fail to recombine if you allow the stock price to fall by the discrete dividend amount. When it goes ex-dividend, the lattice fails in its recombining requirement. Therefore, continuous dividends is typically unrealistic for stock options, but it is one way to handle the lack of recombining. Probably the most efficient way to handle discrete dividends is to bifurcate the stock into two components: the stock without the present value of the dividends over the option life, and the present value of the dividends itself. And so if by splitting the current stock price into two components, we're able to avoid the lack of recombining when there's a discrete dividend payment. Multi-period models, there's an implicit challenge in the sense that as I go to multiple periods, the probability of a single path tends to zero. The number of potential paths tends to positive infinity. So I have an exploding number of paths. I have the probability of each path going to zero. The way to handle this problem is with a log transformation, which makes this analysis much more straightforward. Backward recursion for early exercise is the way to go, and we come up with a reasonable estimate of American-style options. There'll be a host of graphs that will be produced in European style with and without dividends. We'll look at sensitivity to the stock price and boundaries, the time value sensitivity. We'll look at plain vanilla as well as digital options, convergence with respect to number of time steps and the role of dividends, and American style will be contrasted with European style. So this first graph, the European style binomial model, we now have, if you recall, we had these boundary conditions and we were looking at actual option mid prices. We're now looking at the theoretical binomial model, not the mid price, but the actual theoretical model. The assumed parameters are down here in the footer. And so again, we see that the upper bound is really non-binding, the lower bound is binding, and the option price asymptotically moves to zero or to the lower boundary condition for European style options. For European style put options, we get a similar pattern, but the hockey stick shifts different based on it being a put, the right to sell, versus a call, the right to buy. If you'll notice the time value, if I take the option price itself and subtract off the intrinsic value, we get the time value. And based on the binomial model, we can clearly see the implicit positive skewness embedded in the log normal distribution. The call and put time values are identical. If we look at both the call and the put, because we assume no dividends and a 5% interest rate, these two cross at the present value of the strike price. And so there's a lot of different things you can do with this kind of insight. The digital options, we have both digital calls and digital puts, where the payout is a fixed dollar amount, and as the stock price goes up, the digital call goes up and the digital put goes down. Convergence, as the number of time steps go up, in the plain vanilla option, it converges very rapidly. The digital options, not so much. If we now look at with dividends, the graphs look somewhat similar, except for we now have a 5% dividend yield, and so the hockey stick breaks at the strike price as opposed to at the present value of the strike price down here, this being the lower bound. And so with the dividend yield equaling the interest rate, the value, the time value breaks at the or the lower boundary is begins to go positive once you get past the strike price. The time values have the similar pattern. You can see clearly the positive skewness based on the log normal distribution. Again, these are just some other graphs that are produced depending on whether it's a digital option or a plain vanilla option. And so if we now examine American style and European style together, the key insight for a non-dividend paying stock is American style options have the same value as European style, but that is not true for American style puts. It is possible for an American style put to be exercised early even if there's no dividend payments. Again, we see the positive skewness. The early exercise feature causes the time value to shift. And again, the put and call values for plain vanillas, how they cross in their behaviors can be explored if you're able to implement these models in R. Looking at when we do have a dividend yield, now the dividend yield begins to influence both the calls and the puts. And so what you'll notice is deep in the money calls might be exercised early, and deep in the money puts could be exercised early, and that has an effect on the time value as well as which lower bound is the option price tends to. And again, these are similar graphs based on the R code. Now that we dive into the quantitative finance materials, we're going to go deep into the one-period model as well as a two-period model. There'll be a lot of notation that's important to get straight in order to understand these models. And so I would encourage you to take some time to get familiar with the notation. Basically, there's an initial trade date. There's the expiration or maturity date, and there's the size of a time step, depending on how refined the binomial lattice is. We could have a zero coupon bond, the value of a risk-free investment at time 0 and time t, some sort of portfolio value, depending on our trading strategy. The underlying instrument is assumed to be S. The options will be O, either call or put. The U and the D is the total return if the stock goes up or down. Delta is going to turn out to be the hedge ratio and the number of units of the financial instrument to enter to hedge the option position. We'll have future and present value functions. We'll have the equivalent martingale probability of an up move, which we'll explore in more detail. The risk-free rate is going to play a key role, and we'll be taking expectations under this particular equivalent martingale measure probability. We're going to model dividends as both continuously compounded or discretely compounded and assume that it's paid at some future point in time. So to begin this setup, we're going to assume a one-period multiplicative binomial framework. When we get to part 2 of this particular presentation, we're going to explore in detail how the stock and options behave within a one-period model.